What's driving markets? Welcome to Market Take. Each week, we'll bring you our insights on the latest market and economic trends that are impacting investments. I'm your host, Michel Dilmanian, portfolio strategist at the BlackRock Investment Institute. This week, we look at how immutable laws can limit extreme policy outcomes. Developed market government bond yields jumped last week after fresh U.S. tariff threats, though the headlines focused on the sell-off in Japanese government bonds. As the U.S. backed off from new tariffs, DM yields fell, showing how immutable economic laws again came into play. Bond markets have started the year with a bang. Developed market bond yields jumped, particularly in Japan, where 40-year yields saw historic spikes. These moves quickly grabbed headlines, but were short-lived as immutable economic laws limited extreme outcomes yet again. Meanwhile, U.S. corporate bond issuance is forecast to hit a record high this year, as companies are leveraging up to fund the AI build-out, as described in our global outlook. This is a feature of the current market environment, in our view. The headlines around the government bond sell-off focused on JGB yields. But we think the story is a global one, where geopolitics are running up against immutable economic laws, specifically the need for sizable foreign investment to finance U.S. debt. Any spike in long-term bond yields could quickly raise questions about debt sustainability. This has already played out, with the result being a moderation of policies. This risk of higher bond yields comes against the corporate sector that's leveraging up. Public and private balance sheets have diverged sharply since the financial crisis, but U.S. corporates have room to take on more leverage, and they're doing so from a position of strength. Yet more leverage overall makes the financial system more vulnerable to shocks, like the yield spike we saw in Japan last week. Against this backdrop of a surge in issuance, we're more selective in fixed income. We prefer high yield over investment-grade debt and short-term over long-term credit. We also prefer direct lending and private credit and favor established large borrowers. Here's our market take. The recent spike and subsequent decline in yields shows how immutable economic laws can limit extreme outcomes. We stay underweight long-term DM government bonds, but still see select opportunities in fixed income. For details, read our weekly market commentary. Go to www.blackrock.com/weekly-commentary. Thank you for tuning in. If you've enjoyed this episode, subscribe to Market Take wherever you get your podcasts.
This content is for informational purposes only and is not an offer or a solicitation. Reliance upon information in this material is at the sole discretion of the listener. In the UK and non-European Economic Area countries, this is authorised and regulated by the Financial Conduct Authority. In the European Economic Area, this is authorised and regulated by the Netherlands Authority for the Financial Markets. Reference to the names of each company mentioned in this communication is merely for explaining the investment strategy and should not be construed as investment advice or investment recommendation of those companies. For full disclosures, go to blackrock.com/corporate/compliance/bid-disclosures.